All right, welcome back, class. Welcome to Chapter 13, Statement of Cash Flows. We are in our final WebEx session for the semester, or at least for this course, that is. And the reason why this is the final WebEx session for this course is because we are now in week 7. In week 7, we are covering chapters 13 and chapter 14. Chapter 13 is the statement of cash flows, and chapter 14 is the financial statement analysis chapter, which is the last chapter for this course. And this week, you will have a chapter 13 homework and a chapter 14 quiz that will be due by this Sunday. If you have any remaining outstanding work, whatever that may be or whatever that looks like, please make sure that it is submitted no later than this Sunday. The reason why all of your coursework is due this Sunday is because the final exam will take place in week 8. The final exam will cover chapters 9 through 14. The final exam is estimated to be 20 questions in length and is worth 20 points. What does that mean? It's worth 1 point per question. Okay. The final exam, again, covers chapters 9 through 14. It is worth 20 total points, which is 20% of your grade. It is 20 questions in length. Here's the good news. The final exam is now open and is available for you to take. I recommend that after today's session, you at least open the exam and take a look at the questions. The exam is open book, open note. You can save your questions, you can come back to it, just don't click save and submit. Only click save and submit when you're ready to submit the exam. So hopefully that will take out any anxiety. It's not timed, so don't worry about that. Just make sure that the exam is taken by October 23rd. That's 10 days from today. October 23rd is the final day of the course. Nothing can be submitted or accepted past October 23rd because it's the last day of the course. Are there any questions in regard to those announcements?
No.
Okay, very good. So again, by this Sunday, you want to make sure that Chapter 13 homework and Chapter 14 quiz are completed and submitted. The final exam is now open. The final exam covers chapters 9 through 14. You can save and return to the exam. It's open book, open note. It's worth 20 points. That's 20% of your final grade. So please do everything you can to do the best that you can on the exam. What more can I say about it? So if you have any questions, comments, or concerns between now and the time that you do take the exam, please feel free to email me, schedule office hours with me, whatever works best for you. Okay, I'm here for your success. That's why I want you to do the best you can. Okay, if you have any remaining work for the course, meaning there's anything that's past due hasn't been submitted yet, that has to be submitted by this Sunday. So please, please, please make sure everything gets done. Last day of the class, October 23rd. It's 10 days from today. Okay. So those are the housekeeping notes. Let's jump into Chapter 13, the statement of cash flows.
Ready.
Great. The statement of cash flows is one of the big four financial statements that we've been talking about through all of accounting. The statement of cash flows is representative of all of the physical cash that flows into and out of the business. The physical cash that flows into and out of the business. The statement of cash flows is organized into 3 categories and reads from top to bottom. One category of cash flows is operating activities. Operating activities. Those are the day-to-day operating activities of the business. That would include things like paying bills, receiving cash from your customers, all that type of operating of the business, operating activities. The second category for the statement of cash flows is called investing activities. And investing activities is a way for the business to raise cash or to pay loans. Investing activities would include things like taking out loans, bonds, and stocks. Investing activities. The primary purpose is to typically invest into the business by purchasing or selling property, plant, and equipment. Investing. And then the last component of the statement of cash flows is financing activities. Financing activities. And that is the raising of cash capital. And we'll talk a little bit more about that in greater detail. Okay, the statement of cash flows, what is it? It's a report that shows the inflows and outflows of physical cash during an accounting period. The statement helps to inform management about the company's ability to generate cash from operations, maintain cash for operating capacity, meet financial obligations, pay dividends, things like that. Basically, the statement of cash flows helps management to make decisions based on their needs. To use cash, of course. The statement of cash flows is used by management in evaluating the past performance of the business according to operations and plan for future investment and financing. It's also used by external stakeholders like investors, creditors, banks, the government, whoever's interested in the business's performance and sees the business as a potential investment by looking at the company's ability to pay its debts and dividends. So in other words, a potential investor like me will look at the statement of cash flows and say, okay, does the company have the ability to pay dividends and the ability to pay its debt using its current cash, its physical cash that it has? So as I mentioned, the statement of cash flows is broken out into 3 primary areas. We have the operating activities, investing activities, financing activities. Operating activities are the day-to-day operations of the business where cash is used. For example, the company purchases inventory using cash. Okay, that's a cash outflow because the company is purchasing inventory using cash. Cash is being reduced, so that's a cash outflow. Another example of operating activity, the company is receiving cash from a customer that had purchased on account earlier. So in other words, last month the customer came in, made a purchase on account, which means they had an accounts receivable. And now here we are a few days later or a month later, the customer is now paying us the cash for that receivable. So we're reducing receivable, increasing cash. And of course, another example would be a customer purchased inventory using cash. So we increase, that's cash inflow into the business. That's operating activities, day-to-day operations of the business. Investing activities is the company's use of cash to invest in the business. And that would include things like purchasing property, plant, and equipment, also known as fixed assets. Property, plant, and equipment. It could purchasing the purchase of property, plant, and equipment by the business is a cash outflow for investing activities. It could be a cash inflow for investing activities if the company is selling property, plant, or equipment. That's not a part of the day-to-day operations. So like, for example, oh, that dump truck I purchased a while ago, I decided I need to sell it. So I sold the dump truck because I no longer need it. That would be a cash inflow for investing activities. And then we have financing activities. Financing activities is the company's ability to raise funds to pay debts and equity of the company. An example of this would be the issuing or retirement of bonds, or the issuing or retirement of loans that the company has either made or the company has received. An example would be, I needed an additional $50,000 of cash to make investments, so therefore I needed to raise capital. I took out a loan. That would be under financing activities. Or another example would be, I have a customer who is having trouble paying their accounts receivable, so instead of the accounts receivable, I made a small loan to that customer to pay me back. That's a financing activity. So here is, I guess, a consolidated version of the statement of cash flows of how it looks. We have cash flows from operating activities first, then we have cash flows from investing activities, cash flows from financing activities. You add or subtract, depending on what it is, all of those up to get the change in cash. We subtract the change in cash from the cash at the beginning of the period to get the cash at the end of the period. So change minus beginning equals end. Now, I will also say, and we'll see this in later slides, to get the cash flow from operating activities, investing, and financing, we take the cash inflows minus the cash outflows to get the net cash flow. Cash inflow minus cash outflow equals net cash flow. Okay? So, and we would do that same thing for...
That's what I was getting confused on the homework. I got the first two, but I was like, I couldn't get the second. I'm like, why am I not? What am I doing? I was like, I know I'm supposed to add and subtract something to get the last two on the homework, but I was just trying to figure that out, what you had just said.
Perfect. Yeah, thank you, Lakeisha, for bringing that up. That is a wonderful point to make, especially for your classmates who may not have yet done the homework. And so, it's to help you with that, what you would do is for the operating activities, investing activities, and the financing activities, you do it one at a time, right? You go cash inflow minus cash outflow for operating activities equals the net operating activities cash flow. Then you would say cash inflow from investing minus cash outflow from investing equals the net cash flow for investing. Then you would do the same thing for financing activities. Cash inflow from financing minus cash outflow from financing equals the net cash flow from financing. So net plus net plus net gets you your change minus your beginning balance gives you the cash at the end of the period. Now, this might be plus or minus depending on what happened up here, right? Because if you have a minus instead of a plus, or a plus instead of a minus, you would just want to go ahead and add those up. But it might end up being minus depending on what happens up here, right? So that's just something to be aware of. And we'll see that in the later slides as well. Well, Lakeisha, I'm glad that you brought that up.
Awesome.
The ending cash flow in the statement equals the cash reported at the company's on the company's balance sheet at the end of the year. So you know how on the balance sheet the very first line item on assets, as you know, is cash. At the end of the year, or the end of the accounting cycle, that cash balance that's reported on the balance sheet should match the cash that's reported at the end of the accounting period on the statement of cash flows. That is the direct relationship between statement of cash flows and the balance sheet. And we'll talk a little bit more about that here. So again, cash that's coming into the business, we call that a cash inflow. And cash that's going out of the business, we call that a cash outflow. Think of it like the ocean. You have waves coming in, you have waves going out. When the waves are coming in, it's an inflow. When the waves are going out, it's an outflow. The same thing happens with cash. We receive a paycheck, then we use that paycheck to pay bills, right? The paycheck coming in, that's a cash inflow to us. And the cash going out, that's us paying our bills, right? The same thing applies in personal life as it does in business. Cash inflow is your paycheck. The cash outflow is you paying your bills. And the same thing applies in business. Cash inflow is coming from our customers from sales. And the cash outflow is the business paying its bills. And this is a nice visual representation of the cash inflows and outflows. Again, from operating activities, we're making our sales, we're collecting our cash from our customers. Other inflows for investing, we sold some property, plant, equipment. Financing, maybe we issued short-term liabilities or issued some stock to get some cash coming into the business. And on the outflow side, operating activities, we're paying our bills, we're paying our employees, paying our taxes. Investing, we're purchasing property, plant, equipment. And financing, we are paying stockholders dividends, we're repurchasing stock, or we're repaying debt. Just a nice little visual representation there. Okay, so let's take a look at the cash flows from operating activities. So again, operating activities are the day-to-day operations of the business. We have cash coming in from the sale of goods or services to our customers, and we have cash going out, representing us paying our bills, right? Or us paying our employees, or cash going out, right? So companies may select one or two alternative methods for reporting cash flows for operating activities. We have what's called the direct method and the indirect method. The direct method and the indirect method. These are ways that we can report our operating activities. We have the direct method and indirect method. Both methods result in the same amount of cash flows from operating activities, but they're different in the way that we report it. Here's how it looks. The direct method of reporting operating cash inflows and outflows, it looks like this. We have cash coming in from our customers, then we have cash going out for the purchase of inventory, the cash going out from operating expenses, the cash going out for interest payments, cash going out for income taxes, so forth and so on. So we have cash coming in minus all the cash going out to get us to our net cash flow from operating activities. The reason why we call this the direct method is because we're simply showing the consolidated format, right? We have cash coming in from customers, then we have cash going out for various operating activities to get us to our net. We call it direct because we're making it simple. We're categorizing it instead of breaking it all out into detail. So it basically represents the primary reason for operating activities. That's why we call it the direct method. The reason why we might use the direct method instead of the indirect method, I personally like the direct method because it's a simple representation of cash coming in and cash going out. The disadvantage of it is that it doesn't show all of the detail in the accounting records. So, and because of that, it might be difficult for you to identify any type of anomalies. So let's take a look at the indirect method just to kind of show you the primary differences between the two and why we use one or the other, or sometimes both, but usually it's one or the other. The indirect method of reporting cash flows shows us the beginning changes to the end. So we start with the beginning net income. We adjust for revenue and expenses to get us our net cash flow from operating activities. So we take our net income at the end of the accounting period, plus or minus all of our, plus our sales that we made in cash, our cash inflows from operating activities, minus our expenses from operating activities to get us to our net cash flows from operating activities. So net income adjusted for operating activities to get us our net cash flow from operating activities. That's the primary difference between the indirect and direct method, is that in the direct method, we don't utilize net income as a factor for the calculation. We simply do it the direct way. Indirectly, we're using net income and then adjusting plus and minus for the operating activities to get us the net cash flow. So it's kind of like a reconciliation process, and that's why we call it the indirect method. The reason why you might use the indirect method is that it reconciles any differences between the income and the cash flow from operations, the net income and cash flow from operations. This is also another way of connecting the income statement to the statement of cash flows and then ultimately to the balance sheet. So because the data is readily available, the indirect method is a little less costly to prepare than the direct method. That's true, but at the same time, I personally like the direct method because it really helps you to identify as a manager the cash inflows and outflows from each aspect of the business. So your operating, your investing, and financing activities separated out instead of the indirect method where it's consolidated. So let's look at it from this example. We have the direct method compared to the indirect method. The direct method, as you know, it represents the cash coming in from your customers minus your expenses for that accounting period to get you to your net cash flow for operating activities. On the indirect method, we start with net income plus or minus the accounts payables and then minus your purchases for inventory to get to your net cash flow operating activities. In other words, kind of being broken out on the indirect method. But as you can see, regardless of which method you're utilizing, the net cash flow from operating activities is going to be the same for either method. Lakeisha, can you remind us, was there a question on the homework that was similar to this? Yes, no, maybe? I couldn't remember if there was. Okay, well, no worries. But just keep that in the back of your mind. That regardless of direct or indirect method, the net cash flow from operating activities will be equal in either method. So looking at investing activities. Investing activities, again, is the purchase or sale of your fixed assets, such as your property, your plant, or your equipment. Fixed assets is property, plant, and equipment. Investing activities represents the purchase or sale of property, plant, and equipment. The report part, the part of the statement of cash flows for investing activities would be cash inflows from investing activities. That would be the sale of any property, plant, and equipment, minus cash used for investing activities. That would be the purchase of any property, plant, or equipment, to get you to the net cash flow for investing activities. So inflows would be from the sale of property, plant, and equipment. Outflows would be from the purchase of property, plant, and equipment to get you to your net. So inflow minus outflow equals net. It's a very basic formula, but just keep that in the back of your mind. And remember, when we're talking about the statement of cash flows, we're talking about the physical cash. We're not talking about we're not talking about depreciation. We're not talking about anything else that doesn't have to do with physical cash. We're talking about the use of physical cash for operating, investing, and financing activities of the business. And then, of course, the last section on the statement of cash flows is the financing activities. And again, this is the issuance of loans, stocks, bonds, those types of things, right? It's financing. So anytime you hear the word financing, we're typically talking about loans, stocks, bonds, anything to do to raise cash. So on the statement of cash flows for the financing activities component, you'll see cash inflow from financing activities. That would be the business took out a loan, the business sold some stock, the business sold a bond, right? That would represent cash coming into the business. Minus cash outflow of financing activities, that would be the company repurchased stock, the company paid dividends, the company is paying back a loan. That would be cash outflow for financing activities to get you to your net. So again, it's just like before. Inflow minus outflow equals net. Okay. And then once in a while, you're going to have these rare non-cash investing and financing activities. Again, rare, but they do happen. So non-cash. Companies may enter into transactions that involve things like a trade. That's a non-cash activity, a trade. It's like, oh, hey, I'll trade you this dump truck for that backfill machine. Okay, different machinery, but it's a trade. There's no cash changing hands, but there's a change of equipment, right? Another example would be company used common stock to retire long-term debt. We swapped out common stock for long-term debt. Another would be we have a customer that was having trouble repaying us for their accounts receivable. So we changed out accounts receivable. We changed it out for a notes receivable. That would be another example of a non-cash change in financing or investing activities. This happens because Transactions that indirectly affect cash flow are reported in a separate separate section, and it usually appears at the bottom of the statement of cash flows. So here's how it looks. This is a nice example of the statement of cash flows. Again, at the very top, you have your operating activities. Then you have your investing activities, and then your financing activities. So inflow minus outflow operating, inflow minus outflow investing, inflow minus outflow financing. Those all get you to your net. We add or subtract depending on the change, right? So add operating, add investing, add financing to get you to your change in cash, minus the cash at the beginning of the period gets you to your cash at the end of the period. Oh, plus or minus, I guess. And then that gets you to your non-cash, and then you'll have your non-cash investing activities, and that's totally separate. It's a separate line item at the bottom of the statement of cash flows. And again, it's not as common, but it does happen. Okay, a couple of quick formulas that you should be aware of. It may come up on the exam or the quiz, but it's just kind of like a quick mention. And the reason why you need to know this formula is because you need to understand what the company's abilities are when it comes to understanding their ability to pay out dividends. So this formula is called the cash flow per share. And we calculate that by taking the cash flow from operations divided by the number of common shares outstanding. Now you're saying, oh, Dr. B, how do I figure out the cash flow from operations? It's your cash inflow minus your cash outflow from operations, from operating activities. That gets you your cash flow from operations. So cash inflow minus outflow for operations divided by the number of common shares outstanding. And you
Thank you so much. Oh my goodness.
What's that, Lakeisha?
Struggling on that as well. And I couldn't get it. I was like, okay, I got the other, and what am I doing wrong? What am I doing wrong? Thank you so much. I will go back in, and now I can go back in and fit and get those the other two answers that I needed to finish the problem. Thank you, Doctor.
Gotcha.
You are a lifesaver. When I say I need to have this recording in front of me when I'm just doing that homework, you are a lifesaver. Thank you, Dr. B.
You're so welcome, Lakeisha. I appreciate that. So yes, so you take your cash inflow minus your cash outflow from operations divided by the number of common shares outstanding. Number of common shares outstanding, as you know, should be reported on the balance sheet. It's also in the notes too. It's typically in the notes on the balance sheet. It's not like in the balance sheet, as one of the line items, but it's typically classified as a note. Number of common shares outstanding. That's why in the questions that the book provides to you, you'll see it. It'll just be expressed. They'll say, "Oh, the number of common shares outstanding are," and they'll tell you that number. So, or it might have you calculate it real quick. You might say, "Oh, here's the total number. Here's how many shares the company purchased back, or here's the number of shares or additional shares that were issued." It's just a matter of adding or subtracting based off of that information that's provided. But you'll get it. I promise you will. Okay, so this is typically not reported on the company's financial statements because it might misrepresent the cost per share but it's good to calculate it because you do want to know if the company has the ability to repay dividends, and that's really the primary reason why we calculate this. Oh, sorry. Okay, so again, let's talk about the calculations and how they relate to the balance sheet. So the indirect method for reporting on the statement of cash flows uses the logic there's a change in any balance on the balance sheet. So assets, as you know, the accounting equation is assets equals liabilities plus equity. It can be rewritten as cash plus non-assets, which is the same as saying total assets equals liabilities plus equity. Or you can also rewrite it again by saying cash equals liabilities plus equity minus non-cash. Either way you rewrite the accounting equation, it still balances. So therefore, the change in cash account can be determined by rewriting the accounting equation. The formula could also be rewritten by saying the change in cash equals any change in liability plus any change in equity minus non-cash assets. Again, indirect method, it's really not my favorite one because it doesn't explicitly mention the changes from operating, investing, and financing activities. But that's just my opinion. Using the indirect method, there's no real order on the balance sheet that must be analyzed. However, because of the net income, it's a component that gets transferred to retained earnings and is the first account that is normally analyzed. As you know, that retained earnings shows up in a lot of different places, right? Because we take it from net income. Okay, so here's how the income statement compares to the balance sheet, and I'll show you how it compares to the statement of cash flows. You have your sales minus your cost of goods sold equals your gross profit minus your operating expenses to get to your, so gross profit minus operating expenses equals income from operations plus or minus the other, right? The other would be things like selling land, property, plant, equipment, minus any other expenses like interest expense to get you to your total other. So your income from operations minus total other equals your income before income tax. This is also known as EBIT. Minus your taxes equals your net income. And you've seen this before plenty of times. This is just a nice representation of the income statement. Now, how does that transfer to, how does that compare to the balance sheet? Now, as you know, the net income translates into retained earnings at the end of the accounting cycle. And we can do a comparison from year to year. And we're going to talk more about this in chapter 14, but in what we typically do as managers is we analyze the financial statements to understand the changes in our accounts so we can be more mindful and become more effective at utilizing our assets to generate revenue. So, for example, we have 2018 in comparison to 2017. Cash is higher in 18 than it is in 17. So you take your 18 minus your 17 to understand your increase or decrease. And you do that for each line item. And this helps us to understand the net change from year to year. And these changes help us as managers to become more effective at managing our cash flows over time. So looking at the net income in 2018, we had 108,000 as shown on the income statement that we just saw. Since the net income is closed into retained earnings, then the net income helps to explain this change from year to year. And again, the concept behind this is to show you how to analyze the financial statements that we'll explore a little bit more in chapter 14. And of course, as you know, at the end of the accounting cycle, we need to make adjustments to reconcile our accounts. the net income of $108,000 was reported by the company does not equal the cash flows from operating activities for that period. The reason why net income does not represent the cash flows is because there's non-cash activities. Under the accrual method of accounting, as you know, there's going to be things like accounts payable, accounts receivable. And they're recorded at different times other than when the cash is actually paid or received. And this is why the indirect method is often used when it comes to net income to determine the cash flows from operating activities. And here's how this looks. We have our net income. This is the indirect method. We have our net income adjustments made from operating activities such as depreciation, amortization, loss disposal. These are all not the non-cash activities. Plus or minus the changes in other non-cash activities from operating to get us to our net cash flow from operating activities. And again, this represent adjustments. So when we make adjustments to our cash flows for operating activities, first thing we do is we recognize expenses that do not affect cash. That would be things like depreciation, amortization, all that good stuff that doesn't involve physical cash, right? The second thing we do is we identify any losses on disposal of assets or gains. Losses or gains on disposal of assets. As you know, that would be like selling a used piece of equipment or purchasing a piece of equipment. Then we identify changes in the current operating activities, assets and liabilities. We increase non-cash, decrease non-cash, and then increase and decrease based off of liabilities to get us to the net. And here's how that looks. And again, these are adjustments made to the operating activities using the indirect method. It's not going to be as common. It's just really not as common. So, what do I want to show you? Sometimes the company might convert cash flows from operating activities using adjusting entries, and this is because sometimes the business might sell some of their property, plant, and equipment, or they might purchase it, and in such, and of course there might be oh, what happened? Hold on just a second. Sorry about that. There might be instances where the business purchases or sells equipment and there's depreciation involved. The depreciation still has to be accounted for. And so that's why we make these types of adjustments. This example is a sale of land. And there might be an adjustment based off of that land, if it appreciated or depreciated in value. Things like that. And that's kind of the concept behind the adjustments. Let's see here. What else can I tell you about this? Okay. So investing activities. Again, the company might invest in property, plant, and equipment, and there's going to be depreciation involved. As you know, the only thing that does not depreciate is land. However, the overall value of the land might change. And so that's kind of what this slide represents here, is a change in the value of the land and the cash that was used to purchase it. And the same could be said with buildings. As you know, buildings typically depreciate in value. And because they depreciate in value, we need to make the depreciation entry, which is, as you know, a non-cash activity. And that will be adjustments we make to investing, and then adjustments that we make to financing activities. Financing, as you know, would be the issuance or repayment of loans, the repurchase or the issuance of stocks and bonds. And because of these changes, there might be a change in repayment. And when there's a change in repayment, and sometimes that might be according to any type of interest allocated, the total cash paid also changes. And you don't have to worry too much about this. It's just kind of understanding what the potential adjustments might be. What about dividends? So as you know, dividends are the payment that the company will make based off of the ownership of shares. If you own a share of a stock that has a dividend, you'll receive a payment because you own that share of stock. It's usually expressed as a small percentage of ownership, and it's based off of the profit that the company takes in from that previous year. We talked a lot about that in the previous chapters, but I want you to understand that the dividends are a component of the financing activities on the statement of cash flows. And this is just a nice example of what that looks like. Company declared a dividend that totaled $28,000. Looks like two dividends, one per year or one per period, minus dividends payable that was already in the previous account equals the actual cash that they paid out, which is $24,000. And the statement of cash flows using the indirect method. This is a nice snapshot of what that looks like. It starts with net income, goes into the gain or sale of fixed assets, property, plant, equipment. When we look at the change in operating activities, change in investing activities, change in financing activities to get us to our net change in cash, plus the cash that we had at the beginning of the year to get us to our end of year. So again, the way you want to think about the statement of cash flows is look at the categories: operating activities, investing activities, financing activities. You take your cash inflows minus your cash outflows to get to your net cash flow.
Okay, Professor B, that's what I wasn't looking at. When I got to on that, I was wondering how they got at the bottom, how they got that's what I had to do. You said I had to take each category, look at each category, because I was trying to figure out like, okay, what am I doing? How am I got the first two, but I need to get the last. And because we had on the homework, this is on the homework. And I was trying to figure out like what was I doing wrong? What was I not adding up? What was I not subtracting? And I kept just coming up with the wrong. It was like partially correct. And I'm like, okay, what the hell am I doing wrong? So I knew I was close, but I just wasn't putting the number, something I was adding or subtracting wrong, or they just said I was partially correct. So I knew I was in that area. I just
Lakeisha,
had to figure out what to do.
Right.
Lakeisha,
Yes.
you know it's videos that go with each homework assignment, right?
Oh yeah, no, I watched the videos, but it's kind of to me, I don't really do well with the videos.
I
So I
feel
kind of
you.
have my book because I also have the book. So I have the book kind of in front of me. But like when Dr. B is explaining it, because I'm looking at it now, is how it's in the book. And it
Oh,
explain,
okay.
and that's why I'm glad that he's doing this recording, because actually I have the book, and I don't really like the recording doesn't really help me as well as Dr. B when he's explaining it. It doesn't really tell me exactly what I need to know. I can't really pick it up, but as he explaining it, I'm picking it up much easier.
I feel you.
Cool. Yeah. Thank you, Lakeisha. Thank you, Darian. It's definitely helpful to know, especially knowing that those videos are there. I think it's helpful as well. So, but yeah, there's some really good resources that come with that book. So again, when we're looking at it, Lakeisha, from the perspective of the indirect method, we want to make sure that you start off with your net income, because the net income is a part of the operating activities. So net income plus cash inflow minus cash outflow equals your net cash flow for operating activities. And then, of course, you go down the line. You got your investing activities, cash inflow minus the cash outflows gets you your net cash flow for investing. And then you do the same thing again for financing. Cash inflow from financing minus cash outflow for financing gets you your net cash flow for financing. And then you want to go ahead and in this case, we're taking our 100,500 minus the 3,000 minus the 26 to get us to 71.5, plus our cash that we had at the beginning of the year to get us to our end of year. Now, it really doesn't matter whether this is plus or minus, right? Like at the beginning of the year, maybe we were in the red. We didn't have, for some reason we didn't have any cash, or let's say it's a brand new company, there won't be anything at the beginning of the year, right? So just take that into consideration and just treat the numbers as they are. If it's minus, it's minus. If it's plus, it's plus. And that's kind of the approach that you want to take. But regardless, what you want to do is you take the net from each category. Net operating plus net investing plus net financing gets you to your net change, or change in cash. We call it net change. Change in cash plus cash at the beginning gets you your ending balance for the year. That's really the best way to think about it. Okay, another very important topic. I think this is probably one of the most important parts of understanding how to interpret the statement of cash flows. Free cash flow. Free cash flow. This is the available cash that the company has to purchase This is the available cash that the company has available after it's purchased any property, plant, and equipment, and it's done any maintenance to maintain its operations. This is like cash in the. I like to look at this way. It's cash in the bank, right? That the company has to do. They can do whatever they want with this cash. It's cash in the bank. It's cash that they have after they've purchased any property, plant, and equipment, and they can just use it for whatever reason. Okay. Now the formula for free cash flow is our net cash flow operating activities. That's cash inflow minus cash outflow equals net for operating activities, minus any cash used for the purchase of property, plant, and equipment. In other words, that will be the cash outflow for investing activities to equal your free cash flow. So net cash flow for operating activities minus cash outflow for investing activities equals free cash flow. That's another way of thinking about it. But this is a nice formula because it tells us basically the cash that the company has in the bank to do whatever they want to do with it. And the reason why that's important to me is because it tells me the company's ability to be flexible. Free cash flow is often expressed as a percentage of sales in order to provide a relative measurement to compare itself to other companies. Now, it's just in business, we like to compare ourselves to our competitors. We want to say, okay, my business is doing this, my competitors is doing this. How do we compare each other to each other? So we would express it as the free cash flow as a percentage. You take your free cash flow divided by sales, and that gives you the ratio of free cash flow to sales. That ratio basically is a nice way for us to compare ourselves to our competitor. Having positive free cash flow is considered to be favorable, obviously, because that allows the company to be flexible. And it could also say that the company might be able to grow through acquisitions We can make additional purchases. We can get rid of our debt early. We can repurchase stock. We can pay dividends. That's what free cash flow tells me. If I see positive free cash flow in a business, that means a company can be flexible. They can do a lot of different things with that cash. A company with no free cash flow is more limited to what they're able to do. And eventually it could lead to liquidity problems if it's negative. From time to time that does happen. Sears is a great example of that. Okay, let's see. Analyzing it. Okay, so again, we're going to see more of this chapter 14, but what we like to do is we like to compare year to year, year 1, year 2, year 3. We compare things like cash flow, sales, how cash was used. The reason why we like to make these comparisons is because it tells us how effectively the business has been using cash from year to year. And it works the same way. So net operating activities minus cash used to purchase property, plant, and equipment gives us our free cash flow. And looking at our free cash flow from year to year tells us how much more we can utilize in order to be flexible with the business. And based off of what we're seeing, utilizing the ratio, every year the company seems to be improving with its ability to be flexible. And then this last slide is kind of like a recap of the cash flow operating activities, how it's converted from the income statement to the statement of cash flows. So as you know, sales is a result of cash received from customers on the statement of cash flows. Cost of goods sold is the purchase of purchase of inventory. Operating activities, that's cash used for operating activities. Interest expense, cash paid for interest. Income tax expense, cash paid for income taxes to get you to your net operating activities, which is also equivalent to your net income if you're using the indirect method. And of course, the sales represented by the increase or decrease in accounts receivable equals the cash received from customers. So as you know, when I reduce my accounts receivable, that means I am increasing my cash. I'm receiving cash from my customers. And the opposite is also true. Cash received from customers, we have, how do I figure out how much cash I receive from my customers? I take my total sales minus the increase in accounts receivable, tells me how much cash I've received from my customers over time. So again, you're just looking at that change in accounts receivable to tell you how much cash you've actually received from your customers. So sales plus or minus accounts receivable change equals cash received from customer. And you could look at the same method for determining the cash payments we've made for the purchase of inventory. Cost of goods sold plus or minus changes in my inventory. And you'd look at changes in your accounts payable with the assumption that you purchase your inventory on accounts payable. Tells you how much you've paid for your inventory over time. So again, cost of goods sold minus change in inventory minus change in accounts payable tells you how much cash you've paid for inventory over time. And you can do the same thing for expenses. So looking at your total operating expenses plus or minus the change in expenses payable, or accrued expenses payable, equals the total amount of cash you paid for operating expenses over time. And you do the same thing for depreciation, things like that. So cool. That is the end of chapter 13. Are there any questions, comments, or concerns you have about the statement of cash flows before we move on to financial statement analysis, which is the last chapter?
No, but yes, I did have a question for us apart on the homework.
Yes,
You
please.
know, John, when you asked us to journalize, the thing. I tried to press in the box, but how am I supposed to? I thought the box was gonna open, but how do I? Because I was trying to like put it up under. You know how you gotta, do your cash and then you do your accounts payable. And I was like,
Yep.
how do I write that? Do I write it side by side in that box?
No, so there should be two boxes. You should see a box for debit, a box for credit.
Because it's like A and B. It said journalize the entry A and B. So we had to do A and then we had to do B. So
Correct.
it just had a little box right there. And I was like, how do I supposed to write this in this box?
Yeah, you should. It should expand. I'll have to take a look at it.
Okay.
Lakeisha, do me a
Because
favor.
I was
Just
trying to get it to expand too, Professor. Yeah, because I was like, I know I
should
have to put
expand.
it up
Yeah,
under. Yeah, so I was just needed some assistance to probably how to explain that box. I
no
don't know
problem.
the box.
Just do me a favor. Just shoot me a quick email on what question number it is, and I'll take a look at it.
Thank you so much. Okay.
Hey, my pleasure. Okay, I'm going to stop this recording and then I'll restart it for the next chapter. So bear with me.